Strategic Financing Panel, so moderated by Miranda Werstiuk, founder of Fuchsia Capital Advisors.
It's a pleasure to be here. I'm looking forward to this great discussion. First of all, thank you for coming today. It's a pleasure for me to be here. My name is Miranda Werstiuk. I am the founder of Fuchsia Capital, which is an independent corporate advisory group focused on connecting family wealth with projects across the commodity spectrum. Today we have Tim Mister and David Kaplan joining us. We're really looking forward to a robust discussion about strategic capital, new pipelines of capital. Where do we find the capital to develop the resources that we need to go forward, especially in light of this massive shift and energy transition that we're looking at. So Tim and David, I'll let you do a brief intro rather than me reading off your bio. So Tim, go ahead.
Sure. Hi, everybody. Tim Mister. I'm Appian's head of credit and royalties. For those of you who don't know, Appian is a private credit and equity investor in the metals and mining sector. We have just over, I think, $3 billion of assets under management today after a closing of just over $2 billion in our most recent fund, which was announced, I think, a week or two ago. We do invest in both equity, typically in the form of control equity or JV partnerships, in order to help build mines and get them into production. Or we do credit financing and royalty financing for non-dilutive capital solutions. We invest globally, and we invest in both precious and base metals.
Thank you.
Thanks, Tim. Yeah, David Kaplan here. Exactly like that, but we're a little under $300 million. So you can see we have different target audiences, which is good. I started my career at Glencore on the commodity trading side, physical metals. We did some asset investing there. I went and formed Lascaux with my partner Elliot to access these smaller junior miners where banks are no longer banking them on the credit side. We're in harvest mode right now and trying to figure out where the next act will be. Mining is definitely difficult. I think without the battery metals and transition theme, it would be very hard for junior miners to find capital today. So I think this is an interesting topic for us to.
Thank you. Yeah. I'm just going to set a little bit of a stage here. Although it's known that we are really at a nexus point in the industry. Capital is extremely difficult to find, especially, as David pointed out, for those early stage explorers and developers. The challenge is, how do we find the capital? Where is it coming from? How do we engage with the right companies, the right management, and the right projects to make sure that capital is deployed sustainably, correctly, and with a vision to build solid, good projects going forward. Really, as the planet continues to grow, and this is from Deloitte's 2023 mining trends, as the planet continues to grow, population tipping 9 billion by 2030, we are really trying to find out where are we going to get the metals and minerals to be able to support infrastructure growth, support growth of humanity, really. So what we're going to do is we've got sort of a list of questions here, and we'll start with, well, this is weird. So we'll start with sort of the basic topic, and then we'll sort of ping pong back and forth. And then if there's a bit of time, we can perhaps take some questions at the end. Okay. So this one, I'm going to give to you, Tim, to start. Attracting capital in the current high inflationary environment. Thoughts on that? How do we do it? It's a very broad question, but,
Yeah, I think, it's not even just inflation. I think, the equity markets right now are very challenging, as I think people know. In the public equity markets, I do think it is, in some ways an advantage that we don't sit in those public equity markets as private capital. I think that is a big advantage. We can not be short-term thinkers, but long-term thinkers. And so I think what we're seeing is we're seeing more interest in private capital solutions, actually. And that could be in the form of private equity, a partner that can stand behind with the capital already raised, right, and deploying it, or on the private debt side, where we can structure things in a way that's, floating for our investors, which they seek, but also floating for borrowers, such that if interest rates come back down, they benefit from those reductions in interest rates. So I think it is a good time to be a private capital provider in today's industry.
Right.
In the public side, I mean, it's cyclical. It's a cyclical industry, so that will always have those gyrations.
Right. David?
Yeah, I would just, the theory is that inflation hits everything at the same time equally. So, okay, I can sell my commodity at a higher price, but my input should go up equally, so it should be the same. But it's the cost of capital that's a bigger factor in that. The other thing to think about is, in our lifetimes, we've seen, like in the late 80s, super high inflation.
Right.
What we're seeing right now is, I would say, almost normal rates of inflation. So,
Right.
it seems expensive, but it's really not that expensive,
Right.
particularly for the kind of risk we're taking on by building these projects.
Right. And I think, Tim, you and I just spoke briefly about that gap, and we'll get into this, that gap of 2 to 50 million, where companies are really struggling to find that capital, whether you are an explorer kicking off, you're in development, or you're moving into production. And David, we touched on this too. Like, where's that capital going to come from? And I agree. I've done some work for a private lender, and it was in a small sort of 2 to 10 million piece, but it was always 6 months or less before production. So that was arguably the most complicated money to go in, because all the capital had been raised to move that project into production in theory. But there's always upheaval, there's always bumps in the road. So people would come to us and say, okay, we actually need another 10 million, right? We've got enough to get it across the line, but we need a bit of buffer. And that was tricky. That was really difficult capital to deploy. And sometimes it worked really well, and sometimes it didn't. So, okay. Development timelines and new projects, right? The impact on sourcing capital. And last week I had the opportunity to speak to a small group in Toronto who does study work, right, for projects, sort of, I guess, PEA to feasibility. And the vision was, you shouldn't be looking at projects 6 months for production. You should be funding these projects 24 months for production. But that also speaks to when entities look for their ROI, right? So, David, do you want to start with that?
On what should be traditional, I guess. Yeah, I think in the last 10 years, I think the world has seen the need for those types of studies and why we need these long timelines, particularly if it's greenfield. It always takes longer than you thought. It always takes more money than you thought. It will be late. It will be over budget. So the question is, do you have patient capital for that, right? If you're using equity dollars, that works. If you're going to use debt, there's going to be gates and there's going to be timelines and barriers. And so it's, the private solution, I think, works better. And, joint ventures, those types of things, guys that are going to be taking the same risk and don't need their money back in the next 6 months.
Right.
That's the answer.
Right. And I think, Tim, we talked about too that gap, that equity gap. I know in Canada is struggling, like trying to raise capital in the equity markets for that early stage, and even development is very difficult to find right now.
Yeah, the equity markets aren't always open, and I think it does, again, speak to the private capital markets. But independent of all that, I think at the end of the day, it comes down to what is the appropriate form of capital for the risk in a given project. And every single one is different. They're in a different phase or stage. And in some cases, the money is being used for exploration and study, and that tends to lend itself more to an equity-like risk. And in some cases, it's last mile,
Right.
in which case it might be a better fit for a debt capital. So it's hard to kind of generalize it, but generally, the equity market, the public equity market, is very cyclical and goes through these swings, and the private capital market can be a little more long-term driven.
Right. And I certainly saw that, even though we were a lender from the private capital side, that it seemed to be a bit more robust. We followed all the stage gates on due diligence and assessment, but it seemed to flow more readily, right? And companies would come to us who in the past would say, oh, we actually could have raised this 10 million in equity, but there's zero appetite for that right now. So we were filling a gap from the small scale lender side.
Or it's too expensive and dilutive
Right.
at that point in time.
Right. And people were just raising equity and just diluting, like the cap table was just getting bigger and bigger and bigger and bigger. So a struggle on the other end as well. So this actually connects well into, Deloitte's 2023 trends, really all about energy transition at this nexus point. And I think, David, you spoke that you had this energy transition, you've been involved in it, and this certainly from your background. So maybe you can comment on mining's role in the energy transition and how can we source diverse pools of capital for that.
Yeah, that's great. I do think that's where this sector can maybe get back into people's minds, because when you talk about equity markets are closed, I agree with you, particularly for mining. And so what does resonate with investors, people that invest in our kinds of funds, is are you actually doing something that's going to help us 20 years from now, rather than are you making $1 tomorrow? And so, if you fail an ESG test, you're not going to get those capital. So we're not going to get that money, and then the mines aren't going to get that money. So you're looking at a whole different philosophy, is that can we take a waste pile from something that's already been processed? Can we reprocess that? Or can we use some sort of cheaper energy input? Is it geothermal? Is it solar? Is it something different that we haven't thought of before? And so where all the metals are going to go into all those great transition ideas that we're doing. So all of those things, I think, is what the next 20 years of mining investment is going to be focused on, is how do we get those projects? How do we get them funded? How you get that message to the allocators is a challenge. And, I'm struggling with that myself. But I think that is where we're going to all find ourselves back in the money, so to speak, where money's flowing into the space because, okay, great, we need 1 billion electric cars. Where are those going to come from? Where are we going to get those batteries? It's going to come from out of the ground, right? And you can't recycle all that. You can't reprocess all of that.
Right.
Yeah, it's really starting to go mainstream. I think a lot of our investors, folks who provide capital to the private capital providers, are starting to see these themes. It's not just inflation. It was always inflation, but now it's actually, in some cases, pivoting away from the oil and gas space as a way to get commodity exposure. And typically they like to see that with an ESG bent or an energy transition tailwind to that, and so we are seeing a lot of interest in that.
Right, and that's an interesting point. You both mentioned sort of this ESG-driven mandate or focus, and it's not in our notes here, but are you seeing as part of your investment criteria, like when you look at a potential investee company, and I mean this may be a kind of silly question, but are you looking at, like, you have ESG rigor around that, like very much it is a holistic view of all the stakeholders involved in the project?
Yeah, it's a must-have. It's not even a nice-to-have. And I think people in the private capital space have been doing that since day one. It's the kind of thing where if you don't do it, you're not in business very long.
Right.
So it's not just permitting in communities, but it's also health and safety. It's literally the whole value chain. It's absolutely critical, and every one of our investors focuses on it a lot.
Right, and even from a lending, we looked at a small scale producer in East Africa, and a small operation of only 1,000 tons per day, but they were absolutely focused on the ESG piece of their project. There was a huge ripple effect by not taking that into consideration. So I think you can see it from the early stage guys right up to the big ones. David, do you have any?
Yeah, I think it's sort of a paradox, because people look at mining as a dirty business, but the reality is, in order to operate anywhere, to get a permit, to keep a permit, to keep employees, you can't hurt anybody, you can't hurt where you are, and you can't pollute, right? So in a way, mining has to be focused on ESG and always has been. And so I think the message probably wasn't getting across properly. Obviously coal seems bad, but that's still a huge part of our resource base, right? And that's what we're using. So, it's not easy to say, yeah, I'm ESG and this guy's not ESG. I think to be in mining, pretty much everyone has
Right.
been focused on that.
Yeah.
And to attract capital, I think you have to be focused on that.
Well, and I think the industry also has to do a better job of communicating who we are and what we do, that we are, you know, we are not bad people, right? Because in order to function, we need to pull these materials out of the ground, right? And I remember having a conversation with my older daughter, who I was telling Tim is just finishing engineering, and she was adamant, mining, like, why do you fund into that? What's wrong with you? and I got her a couple summer jobs working in the field. So she got to get her hands literally dirty. And she is a very mathy physics kind of kid. And her thesis now, her fourth year thesis, is about real-time data from drill holes. So the math and physics around drilling into specific types of rock. And that could be actually quite transformative to the industry, right? So I was like, oh, yay, finally I got her across the line, because that also speaks to what is, you know, we need to bring young, bright people into this business. And how do we do that? Like, how do we tell our story that we're not, you know, we're not ruining the earth, right? That we are actually doing a good job of pulling these metals out of the ground. So I think we talked about this too, so these early stage projects and how do you pull capital into that? And what's the best type of capital? Because you can talk to companies here, you know, that are early, but they're trying to find capital, right? And I think we can dovetail one of the other questions we have here about joint venture structures, right? And sort of more creativity around funding structures. So, Tim, do you want to start with that?
Yeah, I'll touch on a couple of those topics, and then I'm sure David will have a view. I think, you know, like I mentioned before, the right type of capital is a function of the risk of that most often. And so for very, very early stage stuff, it's just the risk is so high. It's just the natural funding of that is typically the public capital markets. It just is. And then once it's reached to a stage to where you've got a resource that you can understand and underwrite and analyze, and maybe you've got a PEA or not, you will start garnering more interest from the private capital providers as well. And that's where you kind of have a choice, right? You can continue to fund, you know, the development along through to a BFS or a DFS and build it yourself, and that'll require raising a big equity ticket alongside bringing in some banks or some private debt providers. And that's one route you can do, and that does have market uncertainty to it. You know, will you time the market right? Will the project be the right size in the right market and the right backing and have the right momentum? But you have an alternative, and one of the alternatives is private capital. So if you were to partner with a group like an Appian or an RCF or someone else who's on the private side, what would that look like? And you know, there's lots of different flavors you can do. So if you want to sell the project, you can sell the project. If you want to JV, you can JV and keep the upside, right, to the end product as well. So there's lots of different ways you can slice and dice it, and we've done each of those, actually.
Right. So managing risk and finding the right strategic capital at the right time to develop those projects. Right?
That's right. But a lot of it comes down to like things like financing risk, right? So are you actually going to be able to build this thing? You know, can you actually source the capital? And so, you know, taking some of those risks off the table, you know, has a lot of value as well, as we're finding.
Right.
Yeah, that's perfect. And I think the JV model is important. Is, you know, I heard the tail end of Sierra Metals presentation. They're good miners. They make money every year, and they're actively mining. They have projects that are so big, they're going to look to JV them, right? And that's how that model works, and that's why that does work. It should be in production. They don't have the capital or the wherewithal to do it themselves, so they'll partner up on something like that. You know, it's the classic mining company sometimes has a supergene cap or an oxide play, and then a copper periphery underneath it. That's going to cost them $1 billion to build. The first one cost them $10 million to build. So you help them on the first one with an option on the second one. Now you're a JV partner in a big project. So I think, you know, particularly for the juniors, that's the appropriate capital. They just can't do it on their own, but technically they could pull it off, but they need a lot of money to do it.
Right. And I think also we've seen that majors, you know, aren't necessarily, at least the ones I know from Canada, aren't spending a lot of money or devoting capital into that exploration development phase. So by partnering with somebody who's a little more further down the line, further de-risked, to your point, there's an opportunity there to identify projects to move forward with, right? That's also a benefit of the industry. If we're looking for metals and material to support the global growth, we need to have those projects move forward. But I also wanted to mention just royalties and streaming as an interesting piece of funding and potential creative funding. So, Tim, do you want to start with that, given your portfolio?
Yeah, and I think a lot of people are familiar with royalties and streaming. If you're not, a royalty is a percentage of typically the top line, either gross revenue or net smelter, so net of treatment charges. And then a stream is an actual sliver of the metal itself and can then be traded thereafter. So oftentimes those who are interested in the stream actually want to trade the metal itself and find value in that. And otherwise, a royalty tends to just be a financial product. It is a non-dilutive solution, which is helpful in times like today, where cost of equity is very, very high. There are some downsides to royalties and streams, as people are all aware, which is it tends to live there forever. So it tends to be life of mine, which means it captures kind of mine life extensions going forward, and it can be seen as a detriment actually to selling the asset going forward. So there is a healthy royalty and streaming public market, led by the big three, Franco, Wheaton, and Royal Gold. But then there's a whole host of mid-tier and smaller tier royalty companies as well. And they're providing a really relevant function. They're actually a source of capital for some of that early stage work. Because they're creating a portfolio of these royalties, and they don't need all of them to be producing at any given time, right? A lot of them have option value, so that is good, but it has some downsides too. Our approach when it comes to royalties and streaming is a little different. We tend to not be as interested in the really small, super early stage royalties, but rather try to actually attach a royalty as part of an overall non-dilutive solution. So we might come out and say, look, we're going to provide a debt facility to you as non-dilutive capital, and maybe we can actually attach a small royalty or a stream to that to increase the amount of non-dilutive capital and decrease the amount of expensive equity. So we take a modestly different approach, but there's lots of different ways to structure them. It lends itself to a lot of creativity, which is good.
Right, which I think is needed in this environment, right? I think we both talked about that. There's some real creativity that needs to be put in place here in order to be able to fund projects. David, do you have anything to?
Yeah, no, I agree on. I think what's interesting to think about, everyone's done royalties on gold and silver and even some of the base metals, but now that we're looking at these strategic metals, is that going to be the next wave? Is someone going to start graphite streams or royalties, or someone going to do that for only battery products? Who knows? But I think that is where that new capital might come from, because the established guys are doing what they're doing, but they're only doing projects that they think they want to be in for the next 50 years, right? And so can we find the guy that's going to say, all right, I'm going to do this, I'm going to create this portfolio, because most of these mines have one exposure, that's their mine. So if you could put together a portfolio of 20 of those, that's much more powerful than just having that one exposure.
Right. Yeah, I remember talking to the guys at Sandstorm, and they have built quite an extensive portfolio of, and Lascaux as well, these early stage projects. So, hedging that a number of these will turn over into more advanced projects in the longer term. So, I think the last question here is about political risk. And I think, Robert, who is supposed to be here today, sent across quite an interesting PowerPoint about risk and the impact on commodity and supply chain. So maybe, David, you want to start with that? I mean,
Sure.
These projects all function in their own independent jurisdictions. So how do you manage political risk?
Yeah, and I think probably Tim goes through the same thing every time we see a new opportunity, like, all right, where is it? Because there's certain no-fly zones for us from a jurisdiction point of view.
Right.
Before we had war, and before we had other things to think about. But now we have Ukraine, we have Israel, we got problems. And so, you would think, all right, I'm safe, I'm in Europe. Maybe not. Where in Europe are you? And so,
Right.
That is the base. our promise to our investors is we're going to vet this thing, and no matter what, you're safe. We got you covered. And that's harder to say today. And so, in a way, conflict is only good for, okay, we're going to need more metals to sponsor these activities.
Right.
But in terms of following ESG and being in a place and having multiples on your earnings because you got steady state operations, it's harder to guarantee that now as you go. And you look at geopolitical events, not just war, but we've had a new government in Peru every year for the last 5 years, right? I mean, at some point, if you want to put billions of dollars to work, that's not going to be so easy. You heard Freeport the other day say, "I'm scared. I don't know if I want to put $1 billion to work anywhere right now." And so they're the biggest copper producer in the world, right? So I think that is, juniors can say, I'm going to take a risk. I'm going to be in this country in Africa that no one else wants to be in, but it's going to be hard to find dollars to sponsor that activity.
Right. And just what kinds of quantum of capital do you look to deploy? Like, you're in the, we were in the 2 to 10 million range.
Yeah, we were in the 10 to 50.
10 to 50, yeah. Okay. Yeah.
It's definitely one of the primary considerations in every deal. And, people just say jurisdictional risk, but what does that mean? It means, permitting, interaction with the government, tax regime, workforce, ability to get a product out of the country. Like, all of those things are important. And so it is a primary consideration. We look at every opportunity on its own. Not every part of a specific country is the same, just like not every state within the U.S. is the same, right? Everything's different. And so we have to look at it for those considerations. There are other tools that you can use. So there's political risk insurance that you can use, credit insurance that you can use as ways of kind of managing it. But, I know a lot of people are insurance skeptics, that underwriters are way better at writing policies than we are at reading them. But there are some tools out there to use. And then obviously if you're a lender, making sure you have the right sponsor that's backing it, the right company management team, it just becomes elevated. So there are some areas where we just won't go. But otherwise, I think we try to take a creative look at it. I also think it's a slightly different consideration on equity versus credit, how we think about jurisdictional risk. Equity, you have to be able to exit. So you need someone to have a view that they want to purchase this asset from you. And in credit, you need the mill to keep turning, right? And so it's a slightly different risk profile, but it's a big consideration.
Yeah, I know. And we, thank you for that. Both when we were looking at lending, I mean, that was a huge consideration because we were on that last mile, right? That last mile, and then the whole structure. Like, how do you collateralize these transactions? What does that look like? What happens in the event of default? How do you do that? And then managing that risk on a jurisdiction by jurisdiction basis. Well, what if we have to go in and seize the asset? What does that look like? How do we do that? So that was a one of our checklist items, right? It was significant.
We had 3 things. One, will I go visit it? If I hesitate about going, I don't want to be there, right? 2, is there a rule of law?
Right.
Yeah.
Is there a tradition of foreign companies or investors being able to come over and seize collateral, as that happened before?
Right.
And then 3, is there a tradition of mining? Mm-hmm. For instance, a lot of people are putting money to work in Ecuador. Sorry if I upset anyone, but that's new pasture, right? They could change a law and your permit's gone tomorrow. I don't want to be in that exposure. So
right.
I want a long history of traditional mining where the infrastructure is built and there's a tax base and everyone knows what that means.
Right. I mean, at the end of the day, when you're assessing, there's so much volatility and risk that needs to be managed. Like I said, my daughter, she said, how do projects ever get built? Really, at the end of the day, because there's so many pieces, if you look at a project, that impact on the development of that project. Management, the right kind of capital at the right time, managing risk as best you can at each stage of development of the company. And then sometimes just a little bit of a Hail Mary and we can see the vision, but it doesn't always work, right? It doesn't always work. So do you have any last, I know it's a bit shorter than we anticipated, but do you have any last comments or feedback about strategic, pipeline of capital? I think we've covered some really interesting items and topics. If there's any questions from anybody, does anybody have any questions? I know we're wrapping a bit early, but any questions?
Thank you. Thank you both for the talk, and I enjoyed it. I'm just curious right now in this present environment to have such a big raise. Really, what were the marketing components to get people behind this last fund?
Yeah, I think
Thank
I won't focus as much on kind of marketing or any of that, or I just think, you know, and I mentioned this before, we're starting to see some groups that we consider LPs, our limited partners, that are kind of waking up to mining being a part of the solution, actually, which is really refreshing to see, I think. And it's kind of green shoots of seeing that. And we had some folks that joined us that you know, historically hadn't invested in the sector. And so I mentioned there are some that are moving away from, you know, pivoting away or reducing oil and gas exposure, but seeing some of the benefits there, but also just generally like seeing what it's going to take to actually get even close to the targets on the energy transition. And so I think folks are starting to wake up to that. I think that's the biggest thing I would say is just general trend. I mean, the rest is, you know, just Appian's overall, you know, all the things you would expect, track record and team and all the other things. So I don't want to go into that, but I do think the macro is an important theme.
Yeah, I was going to say, I mean, he's being modest. I think track record and team that's the only way you get a meeting. And then, you know, obviously you have to be doing the right things, but they have, and they've been successful. And, you know, it's a very barbell world right now. You have, you know, 1 or 2 Appians and then about 10 little guys, and that's about it, right? It's a pretty small field. Yeah.
Super, thank you. Any other questions? Yeah.
So I'm sorry, I walked in a little late, but you were speaking when I walked in. It was very interesting to me. The concept of the streams and the mechanism around that, and around offtake or the ability to utilize that.
Yeah. So a royalty is just you sell a percentage of your top line revenue, right, forever, and then the stream is you do a sliver of metal, and there's lots of creative ways to do that. So, for instance, if you're a zinc mine with a little bit of silver, you may say, "Well, I'm really focused on being a zinc producer, and the silver is kind of a nice thing to have. Maybe I'll sell the silver as a stream." And there's somebody, a precious metal streamer who values that very highly. They really like that, and they're willing to assign a lot of value to that, and that precious metal streamer's in-house cost of capital might be 5%. So they're willing to actually pay up for that. Now, the trade-off is you're typically giving that up through the life of mine, right? So you are inherently giving up some upside, although in the out years. And in some cases, if your plan is ultimately to sell your asset and there's a stream associated with it, that may be considered a detriment. So there's a trade-off. But in times like where the cost of equity is like nosebleed high, it's so crazy high, that may be a good trade to make, right? It really comes down to cost of capital and what are the gives and takes. Yeah, so it would typically be like if you're out raising $10 million, as an example, you're out raising $10 million, the streamer writes you a check for $10 million and you give them that metal for the life of the mine. And so you can just you can model it out, right? You can say, $10 million going in, what am I going to produce when? What's the commodity price at that time? And do just a simple DCF or IRR to figure out what that costs.
In the very beginning, hundreds of years ago, royalty was a concept. When you're building it, usually the guy would find it and then let someone else build it, but he would keep a royalty on his property. Mm-hmm. And so in the U.S. and most jurisdictions, it goes with the land. So let's say Company A takes it from you, but they fail to build the mine. You just hang out. It's in your top drawer. You wait. Company B comes. They fail. Company C comes. They put in production. They got to start cutting you checks every month when they're in production. So that royalty stays with it. Streaming is kind of a newer concept. Same idea. You're taking a slice, but it's not just, let's say, 1%. It's 10% of your silver production is mine, and I'll just take that off the top. Those typically go with the company, not always with the land. So it depends on how it's structured. So now you're taking company risk as well as production risk. So could be slightly different, but exactly as he said, typically a base metal miner doesn't mind selling a stream or even a royalty on their non-base credit, their precious metals, or the other way around. Precious metal company also makes copper. All right, I'll stream that. So it depends. It's just a source of capital. It is non-dilutive from an equity owner point of view, but it's still dilutive to your revenue. So you end up in the same place. Depends on where you are in the capital structure.
And that market has actually gotten much bigger. It started in the mid 80s on the third party side. So you're right. Sellers would retain a royalty, typically. But then Franco-Nevada really kicked off the space in the mid 80s, and it's really boomed a lot since then. That's been good for mining companies because it's been more competitive, which leads to lower cost of capital for these things. That's a good thing, I think, for the industry generally.
Thank you. And I'll just add, when I was with the French lender, we were prepaying for production. So we would actually, but for a finite amount of time, up to 48 months, 36 to 48 months. But our vision was to trade it on the other side, right? So we had a trading entity affiliated with the company that we would take delivery of the metal as a credit, and then our trading team would get to work on that. Any other questions? I think
So I was before working with MIGA, with World Bank Groups, and MIGA is issuing MIGA investment guarantee, which ensures against political risk, country risk, money restriction. So I think for the Peruvian market, there would be something, feasible to do that, like you mentioned, for the political risk.
Yeah. Anything else? Yeah. Thank you very much. Thank you, David, and thank you, Tim.